SoFi just reported earnings for Q3 2021, which I said in my last video on SoFi was the best opportunity we'd see for the stock price to rise. And the day after reporting earnings, we saw exactly that, with the stock price rising 12%. But while this might look like a massive win on the surface, with SoFi beating their forecast and analyst estimates, there is a lot more nuance to dive into. And that nuance explains why SoFi's rise only puts it back to where the stock was 1 week before earnings. Hey everyone, and welcome to FinTech. In this video, we're going to be walking through SoFi's latest earnings report, talking about how it compares to what we predicted they would report, going through how the company earnings show the company's performing, and talking about what this means for the future of the stock. So hit the like button if you want, and let's start by looking at SoFi's investor presentation. SoFi has always been a company with multiple businesses rolled up into one. So let's begin with just one area of the company, SoFi's financial services business. This included everything from SoFi Money to SoFi Invest to their SoFi credit card. This part of their business was growing at 243% year over year going into their Q3 earnings, and it had added more new financial services products every single quarter since 2019. That trend did not change this quarter, with the company adding 551,000 new financial services products, up 17% from last quarter and up 179% compared to the same quarter a year ago. Now, despite adding a greater total number of products sold, they actually saw a decrease in the growth rate from last quarter. This is simply because as the company grows and their numbers get bigger, larger percentage increases become harder to achieve. It's just really hard to hit 300% growth again when you're already at a much larger scale. This is really the most important metric for financial services, but it also directly tied in with SoFi's number of members and their total number of products sold. Because if one customer paid for 3 products this quarter, that counts as 3 separate financial services products sold. So looking at SoFi's total number of members, that hit 2.9 million this quarter, just shy of SoFi's goal to reach 3 million by the end of the year. The CEO, Anthony Noto, said on their earnings call that they were seeing strong growth trends here. And by the way, for this video, I read through SoFi's investor presentation, their earnings call transcript, and their earnings release to summarize the best parts. And as you can see, those were not short. So if you appreciate that kind of effort, please just hit the like button and let's continue. Their member growth hit 96% year over year this quarter, which is the first time we've actually seen a deceleration in their growth rate here. In my last video talking about my expectations for SoFi's Q3 earnings, I said that any growth under 113% would be a little disappointing, and I do think it's a letdown that we've seemed to be past their peak growth rate at this point. That being said, SoFi reported some other numbers to help offset this slowing growth rate, which I think is partly why the stock rose after earnings. Similar to their number of members, SoFi's total products also grew quite fast, up 108% year over year to 4.2 million total products sold. But that again represents a deceleration compared to their last quarter. Now that again may just be due to hitting too large of a scale to continue those ridiculously high growth rates that they had in the last 3 quarters. This again is not a good sign, but it's not necessarily a big negative for the company either. These areas together show that financial services is still in a hyper growth phase for the company and will likely continue to maintain that at least for the foreseeable future. SoFi will continue to invest in this growth rather than taking profits here because financial services almost act like a top of sales funnel for SoFi, capturing customers at a low customer acquisition cost to later cross-sell them to SoFi's more valuable products like lending as they move down the funnel. The other area of the company that is still strongly focused on growth as well is SoFi's Galileo Technology Platform. The Galileo Technology Platform was originally a completely separate company that SoFi paid $1.2 billion for back in 2020 as an acquisition. This is a platform for enabling digital payments, offering APIs that other companies can use to build their payments processing. This technology services division also holds a lot of SoFi's future potential for creating new products that aren't just digital versions of existing banking services. Galileo hit 89 million accounts this quarter, which honestly is a staggering number, putting them up 80% year over year. This is again a sequential deceleration compared to their last few quarters, and I had hoped that we might see one more quarter of above 100% growth. But instead, they slowed nearly 39% from 119% to 80%. A pretty big drop. At the same time, we expected this to happen eventually. I mentioned in my last video that their number of accounts is now more than a quarter of the entire US adult population. so they can't really keep on doubling every single year going forward. But even though this kind of slowdown would ordinarily be a bearish sign to me, the CEO said something on the call that really changed my mind. See, since SoFi acquired Galileo, they've been in the process of moving their technology from a custom-built on-premise data center and into the cloud. This would ultimately make their tech more performant, cheaper, and more available. Well, this quarter they announced that they now have their cloud stack fully built, and all that is left is to finish migrating applications over. They also now said, quote, "We can reallocate our resources more offensively and launch new products and services." Spending offensively to start launching new disruptive products is exactly what SoFi needs from Galileo right now. And this isn't just a story that company leadership is telling us. It's showing up in the numbers too. SoFi has declared that they want to keep their margin between 20 and 30% to make sure that they're investing the rest of their earnings into new products and improving the company. So when an analyst on the earnings call asked why their Galileo platform had margins higher than that this quarter, Noto had a response. He said there are some quarters where they simply can't spend enough to keep their margins in the desired range, but they think the growth opportunity here is enormous, and we don't want to underinvest in it. He also said that there will be a series of other products that unfold in 2022 that will drive even more revenue against their existing 89 million accounts. So 2022 may be the year when Galileo switches from a growth engine to a profit and growth engine. And that's without even addressing the massive cross-selling opportunities, which I think are one of the biggest takeaways of all from this earnings call. But before we get into those, let's finish up by talking about some pretty big news with SoFi's last and most profitable business segment. Lending. Lending was really the star of the show in this earnings report. While every other area showed a deceleration in growth, lending actually grew faster this quarter than in any previous quarter, up 15% year over year to 1 million lending products sold. Their loan originations also hit $3.4 billion, up 33% in that same time. This was mostly driven by personal loans, which SoFi is seeing a lot of success with, both from new customers reaching out and from cross-selling existing customers from other products. But while those numbers looked really good and do start to show the acceleration we would expect to see as customers start to move down SoFi's sales funnel from their apps like SoFi Money and SoFi Invest and into their lending business, that's not even the biggest news this quarter with lending. No, the biggest news was SoFi launching a next-generation underwriting model in student loan generation that lets SoFi address a larger number of customers' loan requests. See, for a typical loan company, they might receive 1 million loan requests, but they can only service the small percentage of those requests that fit their risk model, maybe borrowers that have credit scores over 700. So if you're SoFi and you want to still capture those less qualified borrowers, but you don't want to put yourself at risk by making risky loans, what do? Well, SoFi partnered with Pagaya, a company that uses artificial intelligence to underwrite loans that normally would be missed by traditional FICO scores. 70% of people who reach out to SoFi for loans do not qualify for a SoFi loan, but SoFi is now able to evaluate them using Pagaya's advanced underwriting models and then send them out to their network of Lantern partners who are willing to give them a loan. This keeps SoFi's balance sheet clean, lets SoFi have a good relationship with that customer, and SoFi gets paid for referring the personal loan. It's a win-win-win. Now, if you watched my last video on Upstart, you'll know that they operate in a very similar realm to Pagaya. While I do think Upstart has a better model than Pagaya since they are working with more data, I don't think that there is a competitive risk there quite yet. After all, SoFi is not focused on competing with other fintechs, but rather legacy banks, specifically the 500 million accounts across 4,700 FDIC banks that are up for grabs by any fintech company today. This whole ability to start capturing more and more of the loan market will be key to SoFi's vision of capturing customers for life. Now they don't only have to go over well-off people with really good credit. They can also grab people with bad credit, hopefully help them improve their financial situation over time, and make them a lifetime customer. But we've talked a lot about SoFi's individual business segments. Let's now back out one level and review SoFi's numbers as a whole company and how everything we just talked through will affect them going forward. So SoFi reported revenues of $277 million this quarter, up 17% quarter over quarter, beating the high end of their forecast. We did expect a beat here since anything else would have been a ridiculous slowdown in growth, and I talked about that in my last video. This is a great example of where following analyst estimates is, in my opinion, absolutely ridiculous. Since according to Google, analyst estimates matched the high end of SoFi's own forecast projections at $200 $255 million in revenue for the quarter, which we knew was probably lowballed guidance. This is also why I say that beating estimates is not always good enough. Sometimes you need a little bit more for the stock to really rise. Luckily, SoFi did have some more good news. This marked their 5th consecutive quarter of positive EBITDA at $10 million, which the company credits to an ongoing focus on operating efficiencies. But then we get to the more surprising parts of their earnings report, which I believe offset some of their other areas of slowing growth. The two big upside surprises were their huge success in cross-selling and their next quarter forecast. We know SoFi's model is like a sales funnel, but up until now, we haven't seen a ton of customers moving through that funnel all the way from their mobile app to their lending product. We know it theoretically should work, but this quarter, we saw it in action. In addition to seeing the acceleration in lending products, SoFi drove a 65% sequential increase in cross-buy volume amongst SoFi Money members. They also gave us a super interesting fact on the call, which is that when a bottom of the funnel loan is cross-bought, so a customer that started with another SoFi product before finding the lending platform, the lifetime value of that member doubles to more than $1,600 versus a loan-only member. And the lifetime value for a loan-only member was already very high for SoFi's industry. This is a good indication that the cross-selling opportunity might be even bigger and more profitable than we initially thought. Not only do you capture customers for lending cheaply, but they are also just more valuable customers than the ones coming into loans directly. As we see more customers start to move down the funnel, it could set SoFi up for explosive profitability growth to match their already very high revenue growth. This also tied in with SoFi's much more aggressive marketing this quarter. In addition to the $625 million that SoFi committed for branding SoFi Stadium, they also drove an additional 400 million impressions and 775,000 engagements with SoFi content through influencer campaigns. Their SoFi Money Moves campaign on TikTok drove more than 8 billion views and more than 1 million uses of their branded hashtag so far. But despite the massive increase in marketing spend, SoFi is still hitting the long-term customer acquisition cost goals, mainly because of the cross-selling opportunity. Maybe it costs $15 to acquire a customer for the first time for SoFi Money, but once they are on the app, it doesn't cost anything to move them over to SoFi Invest or to SoFi Lending. You pay the acquisition cost once, and you get the benefit for a lifetime. One example they gave was when someone signed up for SoFi Relay, which does credit score monitoring and expense tracking. They could see when someone has a ton of credit card debt and offer them a lower interest personal loan to clear out those cards. Or if a customer had a bunch of cash sitting in an account, they could set them up with a financial planner to help them invest their money with SoFi Invest. This SoFi ecosystem, which I've compared in the past to Apple's walled garden, is really starting to bloom and see positive compounding effects. So what can we expect to see from SoFi going forward? Well, we can expect their EBITDA to remain pretty flat, with them forecasting between $2 and $5 million. This is because they want to keep investing to drive growth and pretty much strike while the iron's hot. They still expect headwinds from the extension of the CARES Act affecting loans, which they estimate at a value of $52 million in negative impact. Despite this, they have raised their overall revenue guidance. They expect to see $272 to $282 million in net revenue next quarter, up between 49 and 55% year over year. They say this is an acceleration, but it's also comparing to a much easier comparable quarter, since Q4 2020 had much less revenue than Q3 in 2020. So I don't know if you can really call it an acceleration, but the company is on a good track, so I won't complain too much. They are very bullish on financial services and their Galileo Technology Platform, driving much of their sequential growth, and they expect their investments in those areas to start paying off next quarter. For the full year, they expect to see $1 billion in net revenue, an increase over their earlier yearly guidance. And this is partly because the company has developed this somewhat unique ability to shift its focus based on economic conditions. Obviously, the CARES Act delaying student loan payments hurt SoFi's formerly largest loan segment, but they were able to diversify into personal loans to make up the difference. They gain a sort of stability through diversification of income sources, which is something that not every fintech company is able to do. So to summarize my thoughts on this report, I was a little disappointed with SoFi's overall growth in financial services and products, but that was pretty much offset by their very impressive performance in cross-selling their products to existing customers. I was happy to see their roadmap really starting to take shape, and And with the bank charter still on track to be obtained soon, I don't see any negative bumps in the road coming up in the next 3 months, while there are obviously still positive catalysts for the stock price. And with Galileo now focusing on creating new products, from my perspective, everything is set up for SoFi to start running over the competition. Now we just need to wait for the market to realize it. But let me know what you thought of SoFi's earnings. Don't forget to like and subscribe, and I'll see you next time.